How to get rich without even trying.
It's Brian Preston, the money guy.
Brian, I am so excited about today's show because I think it is like practical, actionable advice that everyone can use. This is going to focus a little bit on like earlier stage or earlier sort of mindset, but the mindset we're going to talk about, I think, can help you no matter where you are in your phase of wealth building to kind of remind you what got you there.
Yeah, we had a strategy meeting recently with our YouTube consultant, and he was kind of sharing with us that we're growing so fast that there is constantly an ever new stream of people coming and finding our content, and that makes me so happy. And I think one of the reasons people are so hungry for what we're sharing is that we all know we want to be successful, we want to start building wealth. But nobody knows the why. What's the process? Sure. Or the why is that? What's the how?
What's the how? We know the why.
Because and that's the problem with a lot of things in the financial world is that everything seems so fancy and sophisticated because people are always trying to sell you their system. They're trying to confuse you to get you to buy into their system. They don't ever give you the real answer. And I think that's why the Money Guy show is so unique is that we just go ahead and share the goods on the front end to try to get you to be successful so that our ask is down the road in the abundance cycle, you're so successful that you then consider hiring us. But that it creates a win-win situation. And I love that. But we have discussed a lot of people come here and they go, how do I do it? You guys talk about the behavior, you talk about the habits, but what is the process that actually puts my money to work to get this explosive growth or this exponential growth that you guys are always talking about?
And we talk about, Brian, all the time that building wealth is surprisingly simple, but it's not easy, right? Like it's a very simple thought, a simple process, but it's not easy. And I think that one of the reasons that it is not easy is when you think about like personal finance, we know that 80% of personal finance, 80% of personal financial success is sort of behavior driven, right? And yet we still screw it up. Yeah. Like we still screw it up over and over and over. And I think we see that the average American screws up the behavior part of the equation very, very often.
And that's why I love that we attract the financial mutants, as we call them, people who process the world a little differently. You don't have to have money yet, but you're aspirational and you're doing the things and the behaviors that's going to get you there. But the lion's share of your peers and the people around you are not doing it. And if you need proof, we actually have some data points.
Yeah, it's really, these are sort of frustrating stats for financial mutants. But we know that right now, 47% of credit card users carry a balance month over month. They don't pay it off in full. They actually carry, that's 1 in 2 folks. That is somewhat upsetting. We also know that the average loan term for new cars is 72 months. I think that most people don't even drive their cars for that long. 61% of Americans would have difficulty or could not come up with $1,000 right now for an emergency. And 34% of Americans don't get the full employer match. So we see over and over, like all of these are behavioral things that we as savers and investors and personal consumers kind of screw up. So behavior is a big thing. So if you can figure out a way to fix behavior, you're likely to figure out a way to kind of move yourself on the track to success.
Well, and then I think about, because back to the investing, how do you actually create wealth? A lot of people in this new modern world, they're looking for, how do I cut a corner off? How do I get there even faster? And it's leading them down paths that I worry about as a distraction because when people talk to me, and we see it all the time in our Q&A questions, people will say, hey, I'm getting married or I'm looking for that first house purchase. You know, I think I'm going to make this decision in the next year.
Sure.
Where should I put the money?
What can I do?
And I think people are always shocked when I say, look, if you can't let go of the money for 5 to 7 years at least, you need to be very concerned about putting in there because investing can be scary in the short term because there's volatility. But this has always been in the fundamental basics of how you look at investing, but that's not where the current world is. We're screwing up even the basics of investing.
Yeah, that's right. Like if we want to think about someone who has been a successful investor, someone who's done really, really well, I think all of us, the first name that sort of comes to mind, the first person that kind of like registers on our screen is the Oracle of Omaha, right? Warren Buffett. And when you think about the way that he looks at investing, the way he looks at making his decisions, he's quoted as saying, our favorite holding period, our being at Berkshire Hathaway, is forever. When he thinks about investing and the decisions he's making, he has this like huge long-term focus. And he said over and over again, if you want to be successful, that's how you should think about investing. That's how you should think about building wealth. That's how you should approach it. And yet, what we've seen is investor behavior is very different. In the late 1950s, the average holding period for a stock was about 8 years. As of 2020, it's dropped to just 5.5 months. For the average retail investor, they hold on to a single investment, this measured by stocks, for an average of 5.5 months. It's a far cry from what Warren is suggesting here.
So when people think about the how are they going to start building their wealth and getting things working for them so their army of dollar bills are doing the hard work for them so you don't have to work so much with your back, your brains, and your hands? People are so in the surface of this that whatever they're buying, they're flipping.
That's right.
And 5.5 months later, that is far from being committed to knowing how and where to invest. And so we want to kind of build that bridge. I want to keep you from taking and wasting the calories, wasting the behavior that leads you into these dead ends. It's not actually getting you closer to financial independence. Let's actually walk people through what is the way that you can automatically start creating riches and wealth for yourself without even really trying and wasting those calories.
Now, we've talked about technology and sort of this influx of technology. It's kind of changed the game, right? Investing for folks today, approaching investing for the first time or beginning to think about saving is very much different, I think, than probably the world that your parents saw, right?
Yeah.
There have been introductions of really amazing tools that are at our disposal that we can use that can help keep us on that straight and narrow. And one of the ones that we talk about all the time, one of the ones we often mention on the show, and we often mention when we do speeches, when we do presentations, are target retirement funds.
Yeah, and stick with us because I know there's going to be some trolls that are going to leave some comments. We're going to tell you where the warts are and where the soft underbelly of even target retirement funds are. But we first want to talk about why are these things the solution for the beginners who are really trying to figure out where do I need to take my very first dollars of investment when I don't quite have it all figured out. Why are target retirement funds so valuable to me?
Well, I think what happens for the average person is they get so, especially if you're not someone who comes from a financial background or you don't have a financial education, it's overwhelming. There's so much information. There's so many options. There's so much stuff that you can do with your money, maybe more so today than in any time in history. It's easy to get lost. And a lot of time we get caught in this like analysis paralysis of doing nothing. I don't know what a Roth IRA is. I don't know what a mutual fund is. I don't know any of these things. So I'm just going to put it in my savings account. I'm going to put it in the thing that's safe, that's comfortable, that I know, rather than actually getting my dollars to work for you. And one of the things that we say, Brian, that we love about target retirement funds is that they way simplify things where there's really only two questions that you need to be able to answer to take advantage of these. Question number one is, how much can I save? And question number two is, when do I need the money? If you can just answer those two questions, you, no matter your background, no matter where you are, can start investing and start growing your army of dollar bills right now today.
It cuts through the noise.
That's right.
I mean, when somebody's trying to tell you, hey, which stock should you go buy? Which cryptocurrency? All these things and how you're doing, you can be just overwhelmed. And you mentioned analysis paralysis. How much can you save? When do you need it? Brings that piece of this is what I need to focus on. This is the way of how I do this to be the most productive without wasting the horsepower of your brain so you can actually start building your income and the other things that matter in the background and start the positive behavior of wealth creation.
So they simplify the thought process down to those two questions, and then they kind of take the ball and start running with it. So one of the reasons we as professional financial advisors, as capital allocators, helping people choose where to put their money and how much to put in each pot, is we like that one of the things that target retirement funds bring to the table is broad diversification in a very simple manner. And we just wanted to show a few examples of this. If you look at The Fidelity 2045 fund, right? So that's just go to Fidelity. It's their fund that is targeted for funds that need to be utilized in the year 2045. It has about 54% U.S. equity, about 36% international equity, and then about 10% fixed income.
Yeah.
You could look to a different provider like Vanguard, one of the largest providers of target retirement funds. They're at 52% equity, 34% international, 14% fixed. Or you can look at Charles Schwab, a third option, 56% U.S. equity, 29% international, 15% fixed. With just buying one fund, you automatically are able to diversify your assets. You're automatically able to get exposure to different areas of the market instead of trying to figure out, oh man, do I buy large cap or small cap or international? The fund kind of does it for you, once again, preventing you from having to initiate a behavior that could lead you down a negative path or lead you down the wrong path.
Yeah, and I love that we laid this out where we showed three of the largest providers of target retirement funds, how similar they are. So you don't even have to waste the brain power of figuring out which of these is better. As you see, they're very similar. They're all very similar.
Close.
But the power of this is why we talk about target retirement funds, is that I know for somebody just starting out, one of the things Bo and I deal with all the time is when we're looking at prospects or people who bring their portfolios with us, is that a lot of investors are guilty of having a patchwork of a portfolio, meaning it's not all working together. You don't have the asset allocation because maybe you have an IRA that you bought in the 90s that's doing this thing with all the technology funds. You've got another one in the mid 2000s that, was taking advantage of some of the real estate stuff, but none of them are all working together. And that's the problem, is that a 20-year-old version of yourself is going to have a completely different investment path than the 65-year-old version of yourself. But that's where you get a lot of complications that I think a beginner doesn't need to be worrying themselves about. They need to figure out, how can I save and how can I get more working? I love target retirement funds. They take all the guesswork about the asset allocation completely out of the equation because they take advantage of what they call the glide path. And we actually have the definition of what is a glide path. Bo, you always do a much better job of reading or giving the definitions. Talk to them about, from a CFA's perspective, what is a glide path?
Yeah, so a glide path is an investment strategy that adjusts the mix of investments you hold over time, aiming to reduce risk as you age. It's exactly what you said, Brian. A 20-year-old's portfolio should likely look different than a 65-year-old's portfolio. Well, one of the things we love about target retirement funds is that they understand that and they naturally do that for you. So if you have a long-dated fund, a 2045, 2050, 2060 fund, it's going to be more aggressive because you have a number of years before you're going to need to access those dollars. But as you move through time, that portfolio, that fund will get more conservative for you. Again, that way what you can focus on are those same two questions. When do I need the money? How much can I save? When do I need the money? How much can I save? And it will do the rest for you. It will actually glide along the correct path from where you are today to where you want to be when you need to access these funds.
Well, we even had Daniel pull together a visual of what a glide path looks like over, and the ranges from age 20 all the way out to age 75. I'll describe it for those that are out there listening to the audio on the podcast side of things. It's very easy to see the aggressive, the risk-on type assets when you're in your 20s with these target retirement funds. It's going to be aggressive too. It's not uncommon to see. I mean, in this example here for the 20-something, you can see U.S. equity is 50 to 60%. International is going to be probably close to 30%. So you see 90% of your money is aggressive.
That's right.
It's going to work. But yet, when you fast forward out to 75, you can see that glide path, just like the name implies, that it's much different. We've essentially flipped it over to where now 30% is in the risk assets and the other 70%, or more of a 50-50 split, because I think they're probably taking advantage of some of the research about safe withdrawal rates and other things where you still do want to have 50% of your money, even if you are living off of it, working for you. This does a lot of the heavy lifting for you, and that's what makes these so tremendously valuable.
And so you're probably thinking, okay, well, you just said that they do allocation for me. meaning they broadly diversify my assets, but they also do my allocation over time. They have these glide paths. That must mean that these things must be pretty expensive, right? They must charge a premium in order to do that, and that's not necessarily true. However, there's a caveat. Not all target retirement funds are created equal. Some providers, some institutions have better solutions than others. We thought this was really interesting. Daniel went and pulled this information from us. If you go look at the American Century 2045 Fund, it is aiming to do exactly what we've talked about. You'll need to access the funds in 2045. The internal operating expenses, the money to keep the lights on, run the fund, that sort of thing, are about 1.37%. That's pretty expensive for a single mutual fund. But if you look at the Vanguard 2045, should be doing roughly the exact same thing, expense ratio of only 0.08%.
Whenever we talk about target retirement funds, one of the first blows that we'll take from people who are trying to poke holes when we share information is that they will pull up an expensive target retirement fund and say, look, those things are too expensive. Don't waste your money. It's not worth it. And I'm always like, look, this is no different than like with Roth IRAs and other things. You are the field general of where every dollar in your army of dollar bills goes. Yes, of course, this would be a problem if you're choosing to put your money to work in very expensive things. But if you're proactive, if you're watching the Money Guy Show or listening to the Money Guy Show, and we're educating you to where you're focusing on how much can I save and when do I need it, we like index target retirement funds. So it's not uncommon at all to find out that we're talking about the three providers that are basically buying index funds. I mean, you can see it, a 0.08% cost compared to a 1.37%. I mean, that we are looking at a 15-fold difference.
It's a big difference.
That goes into your back pocket. That goes into your long-term performance. So pay attention to the where. And then once you even pay attention to the where you're going to invest your money, pay attention to which version of the target retirement fund you're talking about, because we know both Fidelity and Charles Schwab, leaders in target retirement fund space, they offer two different varieties. One is an active management version. One is an index version. Right. Pay attention, because the Fidelity active version costs 75 basis points or 0.75% per year, whereas the index version is 0.12%. At Charles Schwab, the active version is 0.68% annual expenses versus their index variety is 0.08, because not only does where matter, but what you're buying at that where. Pay attention to those details and you can save yourself a lot of expenses. And I think you'll be pleased with the results.
And again, what we like about these funds is that they allow you to focus on what you can control and what you do know and understand presently, which is your savings rate. If you can choose a low cost and index version of one of these target retirement funds, you've taken care of diversification, you've taken care of allocation over time, and you've taken care of fees and expenses. So again, you can focus on putting your money to work, because we've said this over and over, and I think this is maybe the first time we've actually done an illustration on this. In the early stages of building your army of dollar bills, your savings rate is exponentially more important than your rate of return. And we say that ad nauseum. We say it over and over again, but people still ping us. Oh yeah, well you guys only use this percent. What if you make this percent? What if you make this percent? So we said, all right, let's just go and put this in a case study to show you just how important savings rate can be. Let's assume that you have two investors. We're going to have Grace and we're going to have AJ. Yeah. And let's assume that they are coming out of school or they're starting their jobs and they're both going to make $50,000 a year. Okay. Grace decides that she wants to be a really prolific saver starting out. She wants to start saving 12% per year for retirement. AJ says, I'm going to save and invest 10%. So she has a higher savings rate. But let's say Grace says, you know what, I'm just going to go buy a target retirement index fund, fill in the blank, and I'm going to earn 8%. Right, I'm going to earn 8%. And let's say that AJ says, you know what, I can go out and beat the market. I'm going to do a little bit better. I'm going to try to be active and I'm going to be successful in that. I'm actually going to make a 10% rate of return over the next 5 years. Which one of them ends up with more money? Grace, who had a better savings rate, or AJ, who had a better rate of return?
Well, I mean, come on, we're financial mutants. We know how valuable that savings and that investing rate is, especially when you're first starting out. Let's go ahead and share the rest with the audience, though.
After 5 years, Grace will actually have a total account value of almost $37,000, $36,738. AJ's account, even though he had a better rate of return, even though every year for 5 years he was outperforming her by 2%, his account was only worth $32,266. So the one thing that we try to drill into the minds of young people when they're first starting their career, or maybe you're someone who's not starting your career, maybe you're in your 30s or 40s and you're really focused on what can I be doing to improve my overall financial circumstance, we take the stance that your savings rate, especially in the beginning, is exponentially more valuable than your rate of return.
So everybody knows we're huge advocates and we love seeing the magic of compounding growth. But there is a side of this that I think a lot of people don't realize, and we've tried to do illustrations on this, and that's for a whole nother show. We've done it on multiple shows. That first 10 years of investing, you're going to see the lion's share of your money is still what you put in.
That's right.
The exponential growth that comes from compounding is in years 20, years 25, years 30 and beyond. I mean, you've got to have the money working for you for years. So that's why we're trying to make sure we focus on that first quadrant of your wealth building, the beginning years where you are focusing on the savings rate, and it's more of the distractions, all the behavioral stuff that we talked about that's messing up the discipline. That's why we want you to focus on quit sweating the small stuff of, which stocks to buy, which cryptos. Don't let all those weird things. Focus on saving. How can I get more in my money working for me so that in years 20 and 30 and beyond, it's doing better. And that leads to, hey, we get it. Target retirement funds, it's like most things. If there's all this good, there must be a catch to it.
Sure.
And of course there is. And look, we are wealth managers, fee-only financial fiduciary advisors, and we work with clients all across the country. If these things were perfect, we probably wouldn't need to exist
We'd be out of a
anymore.
job.
So, I mean, that's why I love that we can give the nuanced details of why you should focus on this while you're young, but then also tell you as you get older and you have more successes financially, there will come a graduation point where you'll want to move beyond what index and target retirement funds can do for you.
Yeah, we talk about that all the time. We think that they are a fantastic solution for folks who are early on in their wealth building career. Now, that may not mean that you're early on in age. That may not mean you're a young person. But until your dollars reach the critical mass, that it begins to make sense for you to focus on specialized asset allocation and specialized asset location and specialized glide path, target retirement funds are an amazing solution for you. But there is a point when we think graduation makes sense to where you should be probably looking at a better, more robust solution for your unique circumstance.
So let's complete your education, because a lot of you, if you're starting out, you're like, okay, so these guys are loading me up with the tool, but let me know where the warts are, the things to be aware of. The first is, and this is from my background of being in public accounting, taxes. I mean, these things can create some tax headwinds on you. There was a big fallout from year-end 2021 where Vanguard had a big tax bill on a lot of their target retirement funds. You can see there's all kind of Wall Street Journal articles. This blew up, all kind of blogs that I had seen. This was everywhere. A few of you even sent me articles because for years, Vanguard's target retirement funds had distributions of like 1% a year because they're
Super
index
tax
funds.
efficient,
There's tax efficient. And then last year they had a big tax bill. I mean, they had a distribution that was about 18% for like the 2040 fund. That's huge in some aspects. But I don't want people to see this and go, well, see, these
This
things
is why
are
I'm not gonna do
horrible.
it.
This is why we should never, ever, ever do these target retirement funds, is because they're awful for a tax bill. Yes, that is true. But does the tax bill, when you have $1,000 or $2,000 or $3,000 that you put in your taxable account because you've already loaded up your Roth accounts, you've already loaded up your employer plans, and you're now starting in that third bucket, the after tax, Should you just throw these things out? And I'm saying it all depends upon what size your portfolio is. Size definitely matters when it comes to making these decisions. And that's why we give you the nuanced understanding. And we even have a case study to kind of show what we're talking about on when you're analyzing your specific situation and the tax impact.
Yeah, that's exactly right. Now, let's say that you have, again, let's look at two investors here, right? One investor has $5,000 invested and the other has $500,000 invested. And let's assume that they're both in taxable accounts and they're using the Vanguard 2040 fund, right? That's kind of the layout that we have here. Well, capital gain distributions, just like you mentioned, were 18% in 2021 for this specific fund. That means that the smaller investor received a $900 capital gain distribution, and the larger investor received a $90,000 capital gain distribution. Now, before we go any further, Brian, I'm going to go off script here. Is this okay?
Yeah.
One of the things that I see happen all the time when we talk about year-end capital gain distributions, it's often misunderstood. And I have people ask me this question, whoa, hold on, you mean to tell me that this fund had an 18% capital gain distribution, and they told people when it was going to go happen? Why on earth would I not just go buy it the day before it and make an 18% rate of return? Would you mind, as the resident tax guy, speaking to that a touch before we continue on?
Well, when they do these distributions, they will have a stated date that's everybody who owns the fund as of this date, but realize they also lower, believe me, we know from our internal accounting, from our portfolio management software, when they do the big distribution, they will actually adjust the net asset value so it lowers. So you do get the tax impact, meaning you have to pay, if it's in a taxable account, you will pay the taxes on it, but they adjust the net asset value of the pricing of the fund. See, it's not like you actually woke up one day and you had 20% more in your account than you did the day before. It's a big accounting adjustment. It really leaves you with a big tax bill. And that's why it is important when you're in the beginning stages of focusing on the behavior and getting the savings habit, and you have just a few $1,000 in these, that's not going to blow up everything. But that's why we can tell you and be very transparent that these things have a big problem when it comes to much larger account values. You better know what it means for you once your accounts get to $500,000 and beyond, because it can leave you holding a big tax bag.
And so that's a perfect segue back into the example. The $5,000 investor has a $900 taxable capital gain distribution. The larger investor has a $90,000. Well, if you assume a 15% tax rate for the smaller investor and a 23.8% capital gains rate for the larger, the smaller investor will owe about $135 in taxes, while the larger owes $21,420 in taxes. Exact same fund. What we're suggesting is that when your dollars do get to a critical mass, there are ways that you can strategically structure your portfolio to not be quite so tax inefficient. However, when you're young, when you're starting out, when you're building your army of dollar bills, I am not of the opinion that tax efficiency is something you should be focusing on. You should be focusing on one thing and one thing only, mostly. How much can I save and what is my savings rate? If you can do that well, you'll be able to have these conversations around tax avoidance strategies when your portfolio does get to that critical mass.
Now, here's the good news. If you have $500,000 in a after-tax account like this, you're probably a much big holder of a lot more assets. You should have gone pro years ago, or consider moving to a different strategy. The reality is the majority of you watching this content, the lion's share of your money in the beginning when you're in the wealth building journey, because you pay attention to the financial order of operations, is going to be in your Roth IRAs. It's going to be your employer retirement plans. All those are tax advantage type things. It's only when you get to step 7 of the financial order of operations that you're probably the hyperaccumulation stage, that you're going to have the 3 buckets. So more than likely, you're going to have less than $100,000 in these type of accounts, because the other $400,000 of your investable capital will be in those tax favorite things. You're not going to get left holding this tax bag. But we do want you to understand, it's when your total investable assets reach over about $500,000, you better start paying attention to these unique things that add value by you being very active in how you're making your decision making, because it doesn't stop just with these tax distributions. We talk about all the time loss harvesting. There is a great strategy here, and it coordinates with the next point I'm going to make too. When we're in volatile periods like we are right now, there's geopolitical stuff going on, there's inflationary pressure going on, and it's creating volatility in the financial markets. And a lot of you are seeing your individual investments, your mutual funds, your index funds, your ETFs, other things are getting beaten up. That actually creates a very unique opportunity where you can harvest those losses, meaning you go lock them in on paper so that you get to take the $3,000 every year on your taxes as a deduction, plus you get to offset any other gains from other sources. It's a really powerful thing, but a lot of people will say, Brian, but that's just an accounting thing. You're still, because if you just stayed pat and didn't do anything, you would come up with the exact same place. It's just, but that's not true, because when we talk about financial mutants, if you are generous in your mindset, not only do you get to lock in these losses, but if you're giving away appreciated holdings to charity and other things, guys, you want to be more advanced than just index target retirement funds, because you compare some of these strategies together to where, yes, when you harvest losses and then you get that V-shaped recovery where things go up to 20, 30, 40, 100% a few years in the future, you can now donate those appreciated securities. It's harder to do that with a target retirement index fund, because you're basically holding a bunch of funds within one fund. You want to be more specialized so you can choose your winners, donate those, take your losers, harvest those. There's a lot more strategies that go in, and that's probably when you need to know that you should graduate from these target retirement funds.
That's exactly right. When we think about overall financial management, investing is obviously a big piece of it. It's a piece that most people focus on, and some people focus too much on. But we think that when you do get to a critical mass, it really makes a lot of sense for all of the different pieces of your financial life to work together. So the decisions you're making in your portfolio should coordinate with what's going on your tax return. And those two things should inform how your estate plan is set up and how you're thinking about retirement. Well, one of the problems with target retirement funds or index target retirement funds is they don't offer financial planning. Like when it comes to making investment decisions, a big thing you got to think about is, okay, what does retirement look like? We've already said that if you're someone who's planning on exiting the workforce early, maybe before 59 and a half, or certainly before 55, you better think about which of those three buckets you're building and how you're building that. Well, if you need to be placing a lot of focus in an after-tax bucket because it needs to be dollars you're going to draw off of, you're going to have a slightly different investment strategy inside of that bucket that coordinates with your total portfolio. The one set it and forget it target retirement fund might not be the best solution once you've gotten there. We've already talked about tax planning. They don't help a ton with tax planning, especially if you want to do things like Roth conversions or think about RMD type strategies. Target retirement funds don't do that as well.
I also think about this. Tax location, Bo. We didn't even get it. We could have had Daniel put up the slide that we do that shows that, look, your Roth accounts, we love Roth because they grow completely tax-free. So you want to stick it to our favorite taxing uncle, with the biggest growth assets in those. And your tax deferred, that's your employer match and other things you want to put. They're taxed at ordinary income. So you want to put your bonds and other things in that type of stuff that's always taxed at ordinary income. We know after tax, that third bucket on tax allocation, that's going to be your liquidity. That's going to be the bridge account. That's going to be your dividends. That's going to be your capital gain type distribution things. That stuff doesn't happen within target retirement funds, but it does when you're working with a financial advisor. All these things come into play to the full financial planning process.
Again, and that's where then you even get to start thinking about other things like education planning, insurance analysis, and then all the other aspects of investing. One of the questions that we're getting a lot right now from our clients is, man, guys, it seems there's some weird stuff going on in the world. What should we be doing? What should we be changing? How should we be reacting? This is our answer, and this is the email that we keep sending to our clients. We say, look, we have a really solid allocation for your unique circumstance, risk tolerance, risk capacity, account structure, and goals that even before 2022 started being volatile, it was a solid allocation. And in 2022, while we're seeing volatility, it is still a solid allocation. Now, you may see some trades coming through because we are doing a lot of loss harvesting right now, so we can capitalize on that, but we're not changing the allocation. We're not changing the strategy. And then however this year ends up, whether it ends up 20% or down 20%, the allocation, your targeted allocation, is still likely the allocation that makes the most sense for you. All of these are things that a financial advisor, that a professional can begin leaning into and helping you with when you do reach that critical mass moment.
Yeah, so don't be scared to know to hire a co-pilot.
That's right.
I mean, that's one of the things, we talk about all the time is that especially as you're getting close to 7 figures of investable assets, guys, you need to figure out, is this enterprise, you're now the CEO of a 7-figure enterprise, are you making mistakes because of blind spots and just you don't know what you don't know, to make sure you're maximizing the opportunity here? It does make sense, and that's why we talk about the abundance cycle, is that we can love on you, give you all the free advice to help you build the core components. But at some point, and that's why I love it, is that you talked about, you started this off, and I love when I can bring things full circle.
Seinfeld.
You creating wealth is surprisingly simple, but far from easy.
It ain't easy.
And so when I hear the word simple, I'm like, yeah, that's the ideal. The older I get, I want my financial life to be as simple as possible. But the reality is, the more success you start having, complexities go find you.
Yep.
All these strategies we're talking about, as well as all the things that go onto your tax return, you're going to start going, how did I end up in this complex financial situation? And truthfully, you should be congratulated for getting yourself in that situation, but it might make sense for, to find a CFO to help the CEO of this 7-figure enterprise do it the most appropriate and best way possible.
Yeah, so I'm going to give you 2 resources that I think will be super helpful. If you are thinking about hiring a co-pilot, we have a resource on the Money Guy website. Go to moneyguy.com/resources. And is it 8 or 9? It's like 8 or 9, 10 questions.
Yeah.
Questions to ask a financial advisor, either one you're working with or one you're thinking about working with. It's free. Go out there, check it out, use it, and find someone who can answer those questions well. And if you're looking for a great place to look, check out our firm. You can go to moneyguy.com. We have a work with us. We have a little video there. Tells you who we are, how we work with clients, what we do. It is part of the abundance cycle, and we'd love for you to check that out.
So free resources at moneyguy.com/resources. And then, of course, Money Guy as well as aboundwealth.com will have the work with us so you can take that relationship to the next level. I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy team out.